Welcome to Market Outlook 2026. We are talking about how long this bull market can run, because I think that's what's on most people's minds. They're thinking, we've had a couple good years here. We've had a little bump in the road with the tariff crash, and then the market kind of came back. And now everybody's just kind of wondering, when's this thing going to top? When's it going to correct? If it's going to crash? And we're going to get into everything having to do with that and more. So we're also going to go really fast. So feel free to hit the pause button, rewind, go back. Anything you want to do is you slow it down if you want. But we're going to start with a quote of the day. I've got one quote to start, one quote to finish. This one is, time is the only currency you spend without knowing your balance. So use it wisely. I think that's a good way to start. Having nothing to do with the market and more so just with financial planning, retirement planning, and just thinking about money in general. So let's dive into the stock market here. First and foremost, we have the S&P 500, which is unequivocally in an uptrend. We've got tons of daylight here. That's the distance between the moving average and price. Up top, this over here on the left-hand side is the tariff crash, and obviously the market's gone up since then with very few pullbacks, even just this tiny little pullback here in November. But other than that, things are good, things are green, and one concern, if there is a concern, is ironically enough the exact same concern I had last year, which is a negative momentum divergence compared to rising price. So S&P 500, the stock market's going up. Meanwhile, we're seeing lower highs in momentum. That is a hint. It's not a guarantee. It's not if momentum declines, the market will decline as well. It's just a hint. It's a piece of evidence that we need to be watching. It just suggests that it's possible that we might see price follow momentum to the downside, and we might see a pullback or correction. And of course, every correction starts with a pullback. Every crash starts with a correction. So that's something to keep in mind. Next, we have small caps. One of my favorite charts right now, because if you've been watching our market outlooks, our scouting reports, our halftime updates, anything that I've been writing about or recording in the past several years, I've been talking about how I've been watching this small cap chart for a long, long time, waiting for a breakout. And as you can see right here, if you draw a line from this high over here back in late 2021 to this high here in late 2024, we get a big drop in 25, a V bottom. It breaks out to new all-time highs, pulls back, and now we have a confirmation and a breakout here. And right now, not only are small caps doing really well, but these are micro caps. These are the smallest companies traded in the market. And I'm sorry, when we're talking about evidence here, good versus bad versus everything in between, when I see a market that has small cap stocks, small company stocks breaking out to all-time highs for the first time in 4 or 5 years, when I see micro caps breaking out for the first time in 4 or 5 years and actually seeing new all-time highs, I have a very hard time believing we're going to see a market crash in the next month or two. I don't predict. I always say I'm a trend follower, not a trend predictor, but I'm looking at the market and it's telling me what to do here. And we're in uptrends. And as the saying goes, you let the trend be your friend until the end when it bends. So right now, the trend is our friend. The trend is up. There's really no reason to consider it otherwise. We always obviously need to be looking for evidence to the contrary. So evidence that the market is crashing. Let's talk about international stocks. So here's the All Country World Index ex-US. So this is not including the United States. And you can see it looks a lot like the S&P 500. It is actually stronger than the S&P 500, so it's been performing better. And this is actually a new thing, so I'll get to that in a second here. But when we look at the markets, we want to look at where do we want our core holdings to be? Do we want them to be domestically here in the US? Do we want them to be overseas? And if overseas, where overseas? But for the last 16, 17 years, the U.S. has been dominantly just outperforming international stocks, so there's really been no need to look anywhere other than domestic soil. However, this is the last 16 years, and as you can see, with little blips in the radar here, whenever the chart is going up or above water here, above this moving average, that means international stocks are outperforming. When it's below and or trending down, that means it's underperforming. So international stocks are underperforming U.S. stocks. Again, little blips of coming above water here and then falling right back below, almost like this thing can't swim. And every couple years, you see that little breakout and then nothing happens. But this time might be different. And I say that for 2 reasons. One, it's really difficult to have 15 years of underperformance and not see something that looks like more than a year or 6 months of outperformance. And so what we're seeing here is this breakout last year. Then it kind of fell back below water, but it was treading water, we'll call it. And then since then, we're seeing another kind of breakout. In other words, we're seeing this moving average hold here. And if I zoom in a little bit for you so you can see this in more detail, you can see that we broke out, we pulled back, we tread water, we're above water, below water, above water, below water, and now we're heading back up again. So The next line in the sand here, and this is a relative strength chart. Again, it's only comparing international stocks to U.S. stocks. So if it's going up, international stocks are outperforming. If it's going down, domestic stocks are outperforming. So the next line in the sand here is these highs from May of last year. If we can break out above these highs, or at least find ourselves above a rising moving average here, that is a really good sign that we might be seeing a pivot in the direction of international stocks outperforming the U.S. for potentially a sustained period of time. When we look at the dollar, it's the U.S. dollar. This has something to do with why international stocks are doing well. When we see the dollar go up, that's typically good for domestic stocks. When we see the dollar go down, what happens is the price of the exchange rate changes, and that makes international stocks more favorable. I also drew a line in the sand here going all the way back to 2014-15, and you can see here there's this line of polarity, almost like this line in the sand where it was potential resistance above our heads, so like a ceiling of resistance where the dollar would hit that ceiling, fall back, hit that ceiling, fall back, break out, but it was just a bull trap. It just fell right back below that line again. Took a few years, came back above it in 2020, but fell back below that line again, another bull trap. Held the line here in 2021, going back to 2017-18, and then finally broke in 2022. And since then, it was looking really, really good. It was holding what was previously resistance is now a floor of support. It kept hitting those levels of support, breaking out, staying above that line, but then it broke down, as you can see last year, and it's kind of been struggling. And in order for the dollar to do well, and in order for U.S. stocks to start overcoming the strength of international stocks, I think this is going to be a piece of the pie or a piece of evidence that needs to strengthen. If the U.S. dollar continues to struggle, then I think we're going to continue to see things like international stocks outperforming. All right, let's talk about bonds. Bonds, there's just not a whole lot to do jumping jacks about. There's no reason to go doing laps of victory around the block here. This is 20-year U.S. Treasury bonds still in the basement. You can see there since COVID, I just drew a line in the sand at the COVID, January of 2020, and it's just ugly, right? I mean, there's been times where it looked like it was starting to turn around, but then price just continues to head lower. So at some point, this is probably going to turn around, but for now, at least long-term treasuries are not looking good. Some things in the bond market that do look good, though, which, by the way, we own, just full disclosure, for our clients at our office, is convertible bonds. So convertible bonds are bonds that convert to stock. While obviously bonds, like everything in the market, took a beating, especially in 2022 when everything went down except commodities, energy stocks, and things like that. Bonds were down, stocks were down internationally, domestic stocks were down. Eventually at bottom, you can see your convertible bonds started to do well and have, for the most part, with the exception of a couple little blips below water here, have done really well, and it's in an uptrend. So that looks good, but we're looking at another potential breakout above these previous highs just from last year, which also take us all the way back to the late 2021 highs as well. When we look at another bond position, this is international bonds, emerging markets bonds. This is bonds overseas. So think kind of like international stocks. This is international bonds. This has been doing pretty well as well. So there's not a ton of bonds out there doing well, but there are some. You just have to look for them and you have to pay attention and you have to pay close attention because depending on what happens with the interest rate environment, the Fed, Jerome Powell obviously is going to be taking a step aside with a new Fed president coming in. So a lot up in the air right now. So if you own bonds, you have to pay attention, bottom line. You can't just own a broad index, in my opinion. Let's look at commodities briefly. Gold is just, kind of like small cap stocks going absolutely nowhere for a really, really long time, much longer than small caps. If you go all the way back to 2012, the price of gold was pretty much the same in 2024. And then we got a breakout, and that breakout's been parabolic. So this has been a huge year for gold. Same thing for silver. Silver's breakout goes back to pre-2012, and then it was at the same price as just literally the last few months. And then all of a sudden it broke out, and as the saying goes, the bigger the base, the higher in space. And this is a big base right here. So you see this breakout in silver, it's going parabolic, really, really, really high above the moving average. I'm sure there's a lot of people right now that are thinking that they wouldn't want to touch this thing right now where it's at. That's just gone up. It's gone up big and it's gone up fast. So look at oil just briefly here. Oil doesn't look all that exciting. Pretty much since, we'll call it beginning of 2022, it's been trending down with a couple little whipsaws in here, but for the most part, just in a downtrend, steady downtrend, nothing to be excited about in my opinion right now. Look at risk, some risk management stuff, some rankings, so more evidence here. One of the relatives that I like to look at to see if the market looks positive or negative, if the market's healthy or not, is to look at consumer discretionaries versus staples. So discretionaries are like luxury goods, staples are like the stuff that we need to buy at the store. So it's the safe stuff. So when this chart is going up, that means luxury goods are doing better versus staples. When it's going down, it's the opposite. And as you can see, it's been trending up for the most part. And you can see it just recently bounced off that moving average and is higher. It's above a rising moving average. So this is another check mark in favor of a bull market, the stock market doing well. Here's another one of those. So this is technology versus utilities. Technology obviously is an offensive sector, whereas utilities is a defensive sector. Again, if the stock chart is going up, if it's trading above a rising moving average here, which is that shaded area where I like to call it above or below water, then it's offensive. If it's going down or trending down, or if it's trading below water, below this moving average, then that means utilities are doing better. And as you can see here, we're trending northward. We're getting close to all-time highs on this relative chart, which again, to me, this looks offensive. So another positive piece of evidence for this market being healthy and not unhealthy. This is a long-term asset class momentum ranking. International stocks are currently in the lead, followed shortly behind by the S&P 500 or domestic stocks. Small cap stocks, as we just looked at, are breaking out, and they are screaming up into third place here. So you're starting to see a big change in small caps. Commodities are in fourth place, followed by treasury bonds, finally broke out above T-bills, in other words, money market. So basically bonds and T-bills, or bonds and money market, are in the basement here. Understanding that T-bills, of course, are risk-free assets. So if we look at a quick point and figure ranking, just another way of looking at this, point and figure charts remove time from the equation. So instead of looking at a chart with a price and time, or comparing different investments to each other over time, this just compares price and that's it. So all things held constant, if the price of all these different asset classes did not change, the ranking would not change, even if 5 years went by. And right now you can see here, domestic equities or U.S. stocks are in the number 1 slot still. International equities are right behind at number 2, commodities at number 3, and then cash or money market is still beating foreign currencies and bonds, in other words, fixed income. I want to talk about digital assets here, just a few charts. So first of all, I want to look at Bitcoin. Bitcoin had a pretty good year last year and then peaked in October, and it's pretty much fell to the basement. So we're trying to see a rebound. It looks like Bitcoin is trying to come around here, but at least for now, it's below water, really, really volatile as always. But for me, I don't have a lot of confidence in this chart. When you compare it to a lot of the other ones we've been looking at, this one doesn't look nearly as good. This is Ethereum. Ethereum, obviously the call it the little sister to Bitcoin, and similar chart, not nearly as volatile. At least it doesn't look nearly as volatile. And you can see, again, it had a good year last year from April through August. And then since August, September, it pretty much headed down. Now it's been chopping sideways. So again, similar story. There's uptrends, there's downtrends, and then there's trendless. And that's kind of what I'm seeing right here is the lack of a trend, or just trendless behavior. And then when you compare the S&P 500 to Bitcoin, so this is another relative chart where if it's going up, that means S&Ps are doing better. In other words, U.S. stocks are better than Bitcoin. If it's going down, then Bitcoin is stronger than U.S. stocks. And as you can see right now, clearly rising moving average, S&P outperforming Bitcoin, and that's kind of the story. So that's where we are right now. When we look at the big picture, a couple things. I thought this was really interesting. When we did Market Outlook last year in January, the Fear and Greed Index at CNN was exactly the same. I shouldn't say exactly the same. I think it was like 51 last year or something like that. Now it's 53. So where we need to get worried here is when people are really, really greedy. When investors are greedy and we're seeing a lot of greedy sentiment, that's when we need to look for a potential decline, whether that's a pullback, a correction, or worse. When people are really, really fearful, that's where we need to look for opportunities to buy when the market's probably going down. It's already pulling back. It's correcting. Maybe it's crashing, and we need to be looking for a bottom or an opportunity to buy, a low-risk buying opportunity. When we look at the sentiment trader risk-on, risk-off indicator, this is just a compilation of a bunch of different indicators put into one. When it crosses below the red line, it turns red. It does not turn black until it's above the black line. So as you can see here, in November, it crossed below that red line, but it very quickly rebounded, quite a V bottom here, if you will. And now it's sitting very much in risk-on, positive, another, call it, piece of evidence that this market is healthy, or in other words, not unhealthy. Then, when we look at seasonality, this is historical statistics going back all the way to 1949. We're now living in a midterm election year. And in midterm election years, you can see how the market tends to behave. I'm just going to look at the S&P 500, the black line, because I'm colorblind, and it's easy for me. So the black line, you can see here, the market tends to struggle through the first month and a half of the year. Then in February, it starts to climb northward until about mid-April, at which point it declines until the end of June or so, and then it chops sideways, maybe a slightly upward bias, and then tends to bottom out in October, and then the fourth quarter tends to be really positive. So this doesn't mean that's what's going to happen this year, But whenever we're looking at seasonality, whenever we're looking at historical statistics that tend to trend together, and we tend to see those over and over and over again, what we want to look for is differences. If the market behaves differently, then we really want to pay attention to that. But this is what we should kind of expect this year. But obviously, we'll be paying attention to, reacting to, and adjusting to whatever the market actually does. This is a more of a short-term look at the market as a whole. I'm basically looking at this thing saying, okay, is it safe to invest money right now? And again, because I'm colorblind, I use blue and red instead of blue and green typically. So what I'm always looking for is there more blue on the screen than red? I don't want to go through every indicator, every moving average, everything I have up here on the screen, but basically that's the gist of it. You want to see lots of blue, and then right here in the elder candles, you want to see green. And then my inverse traffic light chart that I post every month in our monthly market brief, every quarter in our scouting report halftime update. And of course, this is our market outlook for 2026. Right now, we are solidly in the green. To get down into the caution zone, it would take getting down into those fall lows, which are represented by the November lows. And then that big down day we saw in October was also a low there. So those two lows are where the line in the sand are for me. The caution zone, which takes us all the way down to 6150 on the S&P, top out right here at these highs of early 2025. So if we were to cross below into the danger zone for our tactical portfolio models, meaning our trend following models, we probably would already see a lot of stuff being sold as the market declines into the caution zone and beyond. So when we look at seasonality, if there is a chance that the NASDAQ, so tech stocks, Russell, small cap stocks, if these stocks tend to decline, and they do decline into May, June, July, and August, then that's where you start seeing this chart come into play, where each individual investment that we own in our portfolios, each investment has its own trend. It's not like if the market goes into the red zone, everything gets sold, and if it goes into the caution zone, we buy half. It doesn't work that way. This is just a chart, call it an inverse traffic light chart of the S&P, just the overall market, but every single chart for every single stock, ETF, investment that we own for our clients has its own trend. And if the market starts to crash and there's a couple stocks that just keep going up or a couple ETFs that keep going up, then what's the point in selling them, right? So we just want to keep holding on if that's the case. But anyway, I digress. This is a great chart I always like to finish with. This is mathematically what it takes to make up for a loss. So if you lose 10% in your portfolio, it only takes 11% to get back to even mathematically. Even if you lose 20% in your portfolio, which is not unheard of. I mean, the market goes down about 14, 15% every 18 months on average, and that's just normal. But if you lose 20%, it takes 25% to get back to even. But you lose 30%, now it takes 43%, and it starts getting uglier here. If we're down 40%, it takes 67% to get back to even. And of course, the mathematical equation that we're all quizzed on when you go to kind of nerdy presentations and you watch webinars like these ones, down 50%, it takes 100% gain to get back to even. And I know that probably doesn't sound like it makes sense to some people, but if you do the math, you got $1 million, you lose 50%, you have $500,000, right? If you make 50%, that's $250,000 because it's 50% of 500, you only have 750. So if you lose half your money, you've got to make 100% to get back to even. And of course, if you lose more than that, it gets pretty ugly. The reason I bring this up is because when you're looking at your retirement portfolio and you're gauging risk and you're putting together your financial plan, revising it, as you get closer and closer to retirement, it becomes required. It becomes an obligation to make sure you're paying attention to risk, because it's so much more important to worry about the big losses when you're not adding to your portfolio anymore. You're not adding to your 401k, and you might even potentially be taking money out of it. So when you have these bad years, and someday we're going to have another mortgage crisis, someday we're going to have another dot-com bubble. It's going to be called something else, but it's going to be the same thing, similar anyway. Or as Mark Twain says, the history doesn't repeat itself, but it sure does rhyme. And when that time happens, we have to be ready to react, make changes, and be more protective. So whether you're in a portfolio model that's super aggressive because you're young, that's fine. But if you're middle of your career, later in your career, you might want to start taking things a little bit more conservatively, whether that be in a strategic buy and hold model that's more conservative, or at our office, we not only have that, but we like to invest our clients' money as they get older, as they get closer to retirement, into tactical trend following models that not only will be more conservative from the standpoint of relative strength, they'll not only rotate into defensive stocks, defensive sectors when the going gets tough, but they'll also get out of the market altogether and go to cash if things get that bad. I shouldn't even say if, when they get that bad. With that all being said, I don't see a market crash happening anytime soon. Interest rates, the environment looks pretty good. Inflation is shaky, but most of the evidence I just looked through and showed you today, and there's more, by the way, but the stuff I showed you today, the vast majority of it is positive. And what we need to do as investors is we need to ride that trend, ride that wave until that wave ends, and then make adjustments at that time. So I'm going to finish with another quote of the day. And the quote goes like this: on average, we get 80 summers. If we're lucky, don't put off the trip. Stop waiting for life to begin. Stay up late with friends. Get up early to watch the sunrise. Catch every sunset. Book that trip. Go on that hike. Go to the beach. Spend time with those you love and tell them how you feel. And the reason I wanted to finish with that is similar to the reason why I started with the quote I started with today. It's because I think too many times we get caught up in the news, the headlines, the politics, and it's just brain trash. Whatever's happening right now, think back to what was happening 2 years ago and how it's over. Think back to what happened a year ago and it's over, and life just moves on. And the more time that goes by, the less what's happened 5 years ago, 10 years ago matters. And the less anybody cares. So I understand it's emotional. I understand it's scary sometimes. Focus on what really matters in life, which is what all this money is going to do for you, what it's going to buy for you, the time that it's going to give you, and the people in life that you love the most. So with that all being said, thank you for joining us. If you'd like a second opinion on your portfolio, if you'd like a second opinion on your retirement plan, your financial plan, estate plan, if you don't have a retirement plan and you'd like one, please reach out to us at libertaswealth.com. Click the little button that says see if we're a good fit. And then from there, it'll take you through a list of questions and you'll be able to set up an intro call with our team to just get to know you a little bit better, explain our process with you and how we work with our clients, answer any questions. And if it's a good fit to move forward with the process, then we move forward. If it's not a good fit, we just part as friends. So it's super educational. It's super non-salesy. We really pride ourselves on being big enough to matter, small enough to care. We definitely like being boutique and non-salesy, and we like to educate and give the house away for free. So with that all being said, thanks for watching this year's market update, and we'll see you next time.